Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the housing data he's looking at and what it tells him about the housing market in 2026. Before we jump in, I want to say thank you to our sponsor, Trust and Will, for making this episode possible. Logan, welcome back to the podcast.
What a weekend. What a great tracker article to give people an idea about 2026. So I'm very, very ecstatic. And by the way, before we continue, I just want to thank everyone for keeping us a top business news podcast. I think for the year, having the number 6 ranking on Monday morning is very good for us. For a small niche player like us to be ahead of Bloomberg and the Wall Street Journal, even if it is for a short time. Award-winning podcast, Sarah Wheeler.
Yes, absolutely.
That's you. You're the queen, and it's been a lot of fun. It's been a lot of fun this year.
It's been amazing. I love that top 6. That means a lot. Thank you guys for listening. And I have to give you kudos. Okay, over the weekend, you posted a photo. It was an AI photo that looked like you were part of the cast of Stranger Things. And what is the total number of people who have viewed that video now?
It's been a very interesting few days, but of course, I'm a fan of Stranger Things, and I just had a template. And I just went ahead and did an AI thing, and I think we're close to 10 million views now. And it's funny because if you're able to trick maybe actors and makeup artists to think you're part of this thing, it just went crazy. And of course, my analytical side, I'm seeing the secondary effects of what's going on, and the increase in followers and everything, and what happens when you have something go viral. But yeah, was not expecting looking on Stranger Things on Instagram, and then all of a sudden it's me smiling, and then all of a sudden you're like the top marketing thing for the Netflix show. And I'm like, what is going on?
So I think the thing is, we've used viral before, but 10 million is a different level of viral than anything we've done. And I'm sure for you, you're like, really, that's what goes viral, not my economic work?
Listen, no, economics done right is boring. Economics work should never go viral because it literally is not the most exciting thing. Doom porn goes viral, right? And of course, anything with the entertainment industry should go viral. But sometimes even the chart daddy can crack the code, and it's been a lot of fun. And
it was so much fun to watch. I was in Scotland last week and over the weekend, and I was just watching it going, what is going on? This is crazy. So very fun. But let's talk about the tracker, because that was a great article that you published. And the whole point of it was looking towards what are the signals for the 2026 housing market. So let's start with that, and let's start with the forward-looking data.
So of course, one of the things I've tried to emphasize this year is that anytime we have a holiday week, for 2 weeks, just kind of take things with a grain of salt, because you could get some really wild moves on the weekly stuff. And some people might make a little bit too much of it on the up and down side. So I've taken some opportunities to write the tracker a little bit different around holidays. But this one was trying to get people to focus for the month of December, even though December is seasonally a very slow period in terms of inventory starts to fall, new listings data starts to fall, weekly pending sales, total pending, everything kinds of winds itself down, and then we start back up again. Of course, there's seasonally adjusted numbers, and then there's the weeklies. But you can get a glimpse into early 2026, because the backdrop we have now toward the end of 2025 isn't the same backdrop that we had in 2024 or the same in 2023. It is a more healthier backdrop, but very similar to some things at the end of 2022. And the reason I bring the end of 2022, for all of you who remember, 2022 had the fastest crash in home sales in history. Like when you look at the peak in housing demand in 2005, it took all the way down to 2008 to get to the level. We went waterfall dive aggressively. And back then, when purchase application data, the forward looking, was getting so low that it looked to me that we were going to get to 4 million. And the reason I always bring 4 million up all the times for over a decade now is that it's really rare to have existing home sales after 1996 like go below 4 million in any big fashion. We've had some monthly prints go below 4 million, but total existing home sales have not closed really below 4 million. So if that's the case, then the supply and demand equilibrium changes. And we put our 2023 podcast trying to explain that, like a tutorial, trying to teach people forward-looking data. But this year, what do we know? Number one, rates never went back up to 7% like they did last year. We have the best forward-looking demand in terms of purchase application. Now, purchase application data looks 30 to 90 days out. But if you have positive week-to-week data and positive year-over-year data, and its rates are near 6%, the start of 2026 is running off of a positive demand curve. We've never been able to have something with duration for an entire year or even half a year. We've had periods where we've had, 12 positive weekly data in late 2022 to early 2023. We had 12 weeks of positive weekly data. It gave us one of the biggest home sales prints in history, almost 500,000 in February of 2023. But in the past, we just haven't been able to get that 12 weeks. Last year, we were able to get the week-to-week data, at least 12 weeks. I think it was 12 positive weeks, 5 negative, 1 flat. That gave us a couple 100,000 home sales, but then rates shot up right up to 7% again. So right. that kills that. Now it isn't the case. And we can maybe look in the entire month of December to give us an idea of what's going into 2026.
So when you say we never had this in the past, or we haven't, you mean since COVID?
Oh, since the crash. After 2022, right? You run all housing economic models after the biggest home sale crash ever, because then you can talk about the supply and demand equilibrium better. This is why we always tell people, if you're ever going to listen to a housing expert, get their forecasts for 5 years, then get their working models. Make them show you their working models tied to their forecast to see if they're worth anything. And another thing over the weekend is a lot of people are getting that some of the doomers are not real housing analysts. They're entertainers, but not real housing analysts. So this way, at least the tracker was designed to teach people how to read data looking out with current. Now I think it's a unique time because we're still near 6%. The 10-year yield is up this morning. I think we're about 6.3%. Can we just hold this going into the year, and then what happens in 2026, we'll deal with that in January and February. But it is a very healthy backdrop because price growth is slowing down. Inventory's up. It's no longer the savagely unhealthy housing market. Buyers are in the mix. These are things, this is why I love 2025. 2025 is by far my most favorite year in housing post-COVID, because it finally created that equilibrium balance that we've always wanted to achieve, and that we thought we could achieve as long as rates went high enough and some time went by, and you get that balance out there.
So the yearly numbers on the tracker for the purchase application data have been incredible. But what you're pointing out here is that we got not only the year over year because of the comps were so crazy from last year, but the week over week. And that's the growth that you're pretty excited about.
If we can get positive week-to-week data, like I was shocked that we had 20% year-over-year growth in purchase apps last week because we had a harder comp. Like I understand getting it from extreme low levels, and we just don't care about percentage of increase, but that wasn't the case last week. Last week, the comps were much more difficult. So if we can get positive week-to-week data in purchase apps and some year-over-year growth, considering how low home sales are, we can have a growth year. So we have 10 positive weeks in the last 17 put together. If we can just keep that going into December and then roll into the spring, then you got something workable. It's just in the past 3 years, we've never been able to get that traction because the 10-year yield shoots up and mortgage rates get above 7%. But on that factor base, it's a little bit different now. The Fed has already cut 1.5%. They're going to cut another time in December. The spreads are much better now than they were in 2023. So the curve of mortgage rates are less volatile and they're lower. And we always said the data gets better when it's 6.64 down towards 6. If you could just hold it down here with some durations, you have something to work with, because we've seen glimpses of that. But we always have rates to shoot right back up higher.
That is a huge difference between this year and last year, right? Is like we are holding steady on that. Okay, so you talk about the fact that we all know the Fed should cut rates. That doesn't necessarily mean we're going to have lower mortgage rates.
No, it's one of the things about when I do my yearly forecast, I 10-year yield 470 is the top. So when we get up here, I say there's a lot of room to go down. But when we get down to the bottom at 380 and really 4% here, technically speaking on the chart on an upward trend, 4% is a very hard level to break. So I've got to hold my ground here unless two things happen. Jobless claims break. If jobless claims break, it's that thing's all over with. The whole modestly restrictive stance goes away, or the Fed comes out. Let's say I'm Jerome Powell in the next Fed meeting. We believe that we've been too restrictive with policy. The sectors of the economy that are showing softness and weakness are now starting to show some deterioration in their labor markets. So we would like to get to neutral policy as soon as possible. And we do not want to have modestly restrictive policy anymore. If he said that, that's a change. But whenever mortgage rates get down to 6%, I mean, I keep on telling people, man, they do not like this. And it's been years. It isn't by accident that all of a sudden you got this humongous wave of hawks coming out here and trying to push back on rate cuts. They want to stay as modestly restrictive as possible until jobless claims breaks. Jobless claims breaks, they can't really hide behind anything because that's the layoffs. That's the discharge. I've always said that when layoffs start to happen and claims break, every economic cycle post-World War II goes into recession. So we've always used that as the key metrics since 2022. Unless jobless claims head toward 323,000 4-week moving average, do not go into the recession talk. So now it's just a little bit different because policy is not as restrictive as it used to be. The labor data is softer. Without the labor data getting softer, the 10-year yield is much higher than where we are today. But for now, it's somewhat still intact. And the month of December will be very interesting because we might not have tariffs anymore.
Right.
We might have a Fed that says maybe trying to get to neutral. There's all these things that are in play in the month of December that, we head toward the time where Powell's replacement will be talked about or announced. And then we get ready for 2026. And when the forecast comes, remember, forecasts are useless without a model. We want to incorporate everything that we know from the month of December and then go with it for 2026.
Okay, so we had Black Friday. And do you feel like we found out anything by looking at Black Friday numbers about overall economy, what we're looking at?
So we haven't had retail sales, during the government shutdown. And the last retail sales was a little bit stale. But Black Friday's shopping was good on a year-over-year basis. But if you break some things down, it looks like less things were purchased. They're just at higher prices. So there are people that say it was very positive. It's good. People are consuming goods. And so there you go. And then there's people like, look at, there's just less, whatever it is, retail sales are up. 10-year yield went up today. There's some Japanese bond market drama early on this morning. But Powell is going to be talking today. He shouldn't say anything about the economy while he's in Stanford, but people are just mindful. When we get down here to this 4%, there's a reason why it's hard to break this under. It's because policy is still modestly restrictive and the labor market hasn't broken yet.
That's really good. Okay, let's talk about some of the other signals for 2026. You said, we have some positive headwinds. Tailwinds.
To me, the inventory story is such a good thing. Like, you cannot have home prices go up double digits every single year. It was already damaging. Like, the unhealthy housing market started mid 2020, not because home prices were collapsing and sales was that once we were alive and people started buying homes again, that was fine. But the supply and demand equilibrium, the housing inflation was just about to take off. You remember like the media tour we did early 2021 was going on Bloomberg all the time saying, man, we need higher rates. The home prices are going in. So you could say all these things, but then everyone was stuck with forbearance. Home prices are going to crash at 20. It's just like, whatever. In any case, the fact that we are here, price growth is slowing down, wages are picking up. That is truly another awesome story for 2025 that we finally got to a level to where I no longer can say, we have a shortage or inventory is too low, because I'm doing what I did in the last decade. When you get 1.52 to 1.93 total active listings NAR, you're fine, right? It's a workable market, and now it's a workable market. It took a little bit longer than I thought it would, but still positive on that front.
And as you said, that impacts home prices. Where are we on home prices?
Home price growth is slowing down, and everybody should be jumping for joy, right? All these forecasts for all these people for many, many years, right? We had one of the doomers completely lose it over the weekend because, the dude had the biggest home price crash post World War II, tied with 2008, and it didn't work out. Look what's happened. We've ran the 3-year gambit. Home inventory didn't explode. Distressed sales aren't here. We don't have underwater mortgages. Price growth slowing down should be a positive view, right? That is a positive. The buyers are back. The sellers have no control. Remember the statements that I was giving in the second half of 2022 to the media? Oh, yeah. Like I was like, we need higher rates to put home sellers, builders, and investors on their bleeps. Right? Because that is not a healthy market. So what's happening this year has to be viewed on a positive light. I know one of my colleagues likes to say that the Fed is too restrictive. We have to cut rates because home prices are falling, and they're using a price per square foot. And it looks like home prices are down below 2020. It's like, no, that's not how it works. I understand what he's trying to do. He's trying to get the Fed to cut rates more aggressively. But if you really had authentically national home prices below 2024 levels in a noticeable way, NAR, Redfin, Freddie Mac, Case-Shiller, all these indexes would show it. We're just not there. Price growth is slowing. The Fed should not look at that as a thing, and it's a positive light. This is why I'm not for 50-year mortgages. The portable mortgage is not going to work because you can't go back and get those contracts. The 30-year fix is fine. Let the market kind of work itself out. Right? Give it time. Inventory up is good. Buyers are going to go there. They don't have to worry about it. They can get seller concessions. There's all these things that are good. And y'all are just like trying to ruin it.
And also ARM loans, right? I mean, you brought that up in the tracker again.
Yeah. I mean, 2026 will be the first year in many years that people will have access to ARM loans. These aren't the ARM loans of the previous decade. My God, people are just, we see these crazy headlines. Like, oh my God, a product from the 2008. Read a book. Read a book. Don't burn it. Read it. None of these ARMs look like the ARMs of the past. Those things were all eliminated after qualified mortgage, right? There's no 228s, 327s, 100%. All that stuff's gone, right? So the ARM loans will never be as popular as they were, but ARM loans are picking up because it's a sub 6. I mean, it is what it is. But when rates get below sub 6%, the builders are at 2019 sale levels. Right? Because why? They're doing rate buy downs. And why is that important? Because if they didn't do that, new home sales would be worse, and housing permits would be worse, and starts would even be worse. So I'm all for that because you have to make sure that you're still building homes to a degree. But in this case, we've seen ARMs pick up when rates are falling. You don't usually see that with the ARM data. We usually see ARMs pick up when rates are rising. That makes sense. But there's just something about the sub 6% mortgage market that gets things going.
Yeah, no, I mean, people feel like they need to pull the trigger then. That's absolutely true.
Yeah, it's, and again, the biggest Christmas hug, the biggest Christmas kiss, if you see a mortgage spread, go there and get a mistletoe over it, right? And, without mortgage spreads improving this year, we would have not had this discussion.
And we have a little bit more to go. There is some more improvement we could see in mortgage spreads.
We should get near the normal levels next year. It has nothing to do with quantitative tightening ending or anything. Look at all, I know I got that question a lot over the weekend. Does QT ending help the spreads? We have made a major move on mortgage spreads already. We got down to as low as 2.12% to 2.12%. Like the upper end range of normal in the recent decades. I know way back, it was low 1% and under. It was 180. So at one point, we're only 32 basis points away from normal. So we can get there next year. Volatility compresses. Fed rate cut cycle goes. As long as we don't have any kind of drama or anything like that, we should get there. And we've made good improvements from that side. So that's a positive. As long as that sticks, that's another benefit. Going, see all these things, we all put them into the tracker this week to kind of keep an eye on head and go out into 2026. There's a lot of different variables now that are positive. You just have to look at them in the totality of all the data put together.
And we have made it easy for people to find the housing market tracker. It's HousingWire.com, housing market tracker. Go find it. They're listed together. They're on the housing market page. You have all of the charts that you use there on that same page. People can see the most updated. So we know that it's a resource that people really use and like. So we've made it easy.
Yes. And also remember, the tracker is designed with national economics, with national data. You can get your own zip code, right? Wall Street comes to us. Real estate investors come to us. Prolific realtors come to us. Why? Because your local market is different than the national data. The national economic story rolls into usually what happens into regionals. But that's the advantage and we think we give to readers out there, and the disadvantage of those who don't actually have a working model and don't show anything, and their forecasts have been wrong for 5, 6, 7 years, and they just, are doing it for entertainment purposes. We are data miners. We love numbers. Why, Sarah Wheeler? Because numbers are the closest
things to the handwriting
of God. And we always want to be the detective, not the troll. And all American bears have failed since 1790.
Oh gosh, wait! You have to say something about the Peloponnesian War at this point. Right now.
I mean, listen. There's one group of people that have been wrong about America since the Peloponnesian War, but that was, way back.
I love that statement because it's so funny, obviously, from a history standpoint. Okay, well, we are out of time. Logan, thank you so much for being on. Thank you again for doing a great job on the tracker, and we will talk again soon.
Pleasure.